Can you imagine learning an investment method in just 2 weeks that allows you to achieve an annual return of 80%? It sounds exaggerated, doesn't it? But this is exactly what a well-known financial trader named Richard Dennis accomplished. The interesting thing is that he didn't do it just for himself. He decided to teach this methodology to a group of people who had absolutely no experience in the markets. The result? In a very short time, he turned them into highly competent traders. In this video, I'm going to show you exactly what that crash course consisted of, what the key principles of his system were, and how, despite its simplicity, it allowed them to achieve consistent profits. And if you stick around until the end, I'll show you how to replicate that same strategy yourself, because I've managed to find the code needed to do it. Richard Dennis is a legendary figure in the world of trading. He started in the 1970s with less than $2,000, trading in the commodities market. In just 4 years, he had already amassed a fortune of several $1 million. Instead of continuing to accumulate wealth, he decided to test something he firmly believed: that with good training, anyone could become a profitable trader. That's when he partnered with William Eckhart, and together they designed an experiment in 1983. Their goal was clear: to prove that success in the markets didn't depend on innate talent, but on following well-defined rules. They selected 13 participants with no prior experience and taught them a set of basic rules over just 2 weeks. Then, they put their skills to the test in real market conditions, with accounts funded by Dennis and Eckhart themselves. This experiment would later become known as the Turtle Experiment. The inspiration for the name came from a trip Dennis took to Asia, where he observed how turtles were raised in captivity. He was convinced that just as those turtles could grow under controlled conditions, he could also train successful traders from scratch. Before I explain the rules of his system, you should know that it was a trend-following strategy. They didn't limit themselves to just one type of asset. They traded S&P 500 stocks, major currencies, bonds and commodities like gold or coffee. They chose very liquid markets so they could enter and exit without complications and take advantage of volatility in their favor. The first fundamental rule of the system was risk management, which Dennis considered the most critical aspect. His obsession with controlling losses led him to establish a clear limit: never risk more than 2% of capital on a single trade. During training, they used demo accounts, but afterward, each participant received a real account with $500,000 to $2 million. Imagine risking 2% of $2 million. That's $40,000 per trade. Remember, these were people with just 2 weeks of training. For inexperienced traders, that pressure was immense. But the system went further. Position sizing was based on market volatility. Trades only occurred under specific criteria. During drawdowns, loss periods, they further reduced risk. If they lost 10%, they acted as if they'd lost 20%, recalculating positions accordingly. Why? Because they trusted their system's long-term profitability and knew protecting capital during downturns was key to surviving until recovery. I could make many videos about this capital management approach, and probably will, but here I'll focus on the strategy's core principles. The next rule covers market entries, where real execution begins. The second rule actually has 2 distinct entry methods. Let's start with the short-term entry. Signal generation. Enter when price clearly breaks the range established by recent session highs-lows. Tool: Donchian channels, a technical indicator. To visualize these in TradingView, go to Indicators, top left. Type Donchian channels. Select the single result. The 20-period channel will appear on your chart. Entry triggers. Long signal: price breaks above the 20-period upper channel. Short signal: price breaks below the 20-period lower channel. No complex indicators or ambiguous interpretations, just pure breakout monitoring. Before moving on to the next rule, if this content is providing value to you, don't forget to leave your opinion in the comments, like the video, and subscribe if you haven't already. And remember, at the end I will talk about the code for this strategy, and you will decide whether you want me to publish it or not, since behind this seemingly simple system, there are details few people know. Now let's move on to the third rule of the method, entering longer-term trends. What if you missed the opportunity given by the 20-period channel? No problem, because there is a second chance with a wider channel, the 55-period channel. The procedure is the same, but now you are observing a broader range and therefore entries that can capture more sustained moves. To set it up, just double-click the Donchian indicator in TradingView, change the length to 55, and that's it. You have the new channel ready to use. When the price breaks the upper boundary of this 55-period channel, the entry is executed with the same logic as before. You are entering what could become a prolonged trend. Before moving on to the fourth and final rule, which deals with when and how to close the position, there are some key considerations about entry execution worth mentioning. Time frame. Although technically applicable to various time frames, this strategy was designed for daily charts. No waiting for candle close. It was not necessary to wait for the daily candle to close. If the channel breakout occurred during the session, the order was executed immediately. Flexibility. Traders could choose to trade short-term breakouts, long-term breakouts, or combine both according to their judgment and availability. Scaling in. Here comes a very interesting part. Every time the price moved 0.50% in favor of the open trade, an additional 0.50% of capital was added to the position. For example, you enter after the breakout, the price rises 0.50%, and that triggers a 0.50% position increase. If it rises another 0.50%, the process repeats. This could be done up to 4 times, accumulating a maximum additional 2% risk. Now we move on to the fourth rule of the system, which deals with how to close trades, how profit targets are set, and how maximum allowed losses are limited. Instead of subjective references, a specific tool was used to measure the asset's actual volatility, the 30-period ATR, average true range. The fourth and final rule of this methodology focuses on the most important aspect for every trader: when to exit a trade, whether with profit or loss. Let's start with loss control. To set the exit level if the price moves against the position, a specific volatility indicator was used, the ATR, configured to 30 periods. This value reflects how much the price has moved on average over the last 30 days. To activate it in TradingView, simply go to the Indicators section, search for Average True Range, or Rango Verdadero Medio if your interface is in Spanish, and add it to the chart. Then make sure the length is set to 30. Suppose you are analyzing Microsoft and see that the current ATR is 7 points. That tells you the price moves about 7 points daily on average. To place the protective stop, you simply multiply that value by 2. So if you buy at $156, the stop loss level in case of loss is $14 below at $142. That is the zone where you would exit if the market goes against you. Now let's move to the profit target. They did not use a fixed take profit. The system was designed to hold the position as long as the trend continued. In other words, they did not close the trade until the market began showing clear signs of exhaustion. How did they measure this? Very simply, if going long, they observed the lowest price of the last 10 days. If the price broke below this level, it indicated the trend might be ending and it was time to close. For short positions, the same principle applied, but observing the highest price of the last 10 days as the exit point. For longer-term scenarios, for example, if the entry was made using the 55-period channel, this rule was adapted. Instead of using the last 10 days as reference, they used the last 20 days. This gave more room for the move to develop without being interrupted by minor fluctuations. Here's an interesting detail. Although they knew where to exit if the market went against them, they did not leave a stop-loss order programmed in the broker system. Why? Because they wanted to avoid giving clues to other traders or algorithms through the order book. Instead, they manually monitored the price and, if it reached the critical level, they closed the trade at market immediately. This is an uncommon but very strategic practice. All this leads to an obvious conclusion. This system is extremely disciplined. Although it seems simple, with only 4 rules, its strength lies in risk management and execution without room for improvisation. Intuition or emotional analysis was not allowed. Only clear rules, objective measures, and strict application. And now comes the big question. Would you like me to show you the exact code that replicates this strategy so you can use it directly on your chart? Because I have it. I've tested how it works and also seen its strengths and limitations. If you are interested in a video showing the code, explaining its details, how to adapt it, and what you should consider before applying it live, then let me know. Like the video, leave a comment, and subscribe if you haven't yet. Your response will determine if this content becomes a full new video, or if I focus on something else. And before finishing, remember that in the first pinned comment, and also in the video description, you will find links to free educational resources, from practical guides to free courses. This way, you can keep learning without needing to invest money. This translation incorporates the detailed explanation of the Donchian channel rules and trading methodology as described, aligned with the technical context from the search results about the indicator and the turtle trading system.